Okay, good afternoon, everyone. Welcome back to our weekly news broadcast. I'm your host today, Todd Anderson, Chief Product Officer at LendIt Fintech. Joining us is a guest that we've had a few times, Andrew with Crowdfund Insider. Andrew, just remind the audience who you are.
Yeah, I am the publisher of Crowdfund Insider. We cover the full stack of fintech innovation that includes online capital formation, crowdfunding, and blockchain technology. And I guess we probably have an emphasis more on regulatory issues and items like that because I'm deeply interested in that. So thank you, Todd, for having me back. Thank you, Team LendIt.
All right. Well, it's great to have you back. And I think it's a good way to start would be Square Afterpay, which was, as Peter said earlier in the week, probably the biggest news story of the year to date. Square is buying Afterpay for $29 billion in an all-stock deal. I think there was an interesting quote from Jack Dorsey. We can better connect our Cash App and seller ecosystems to deliver a more compelling product and services for merchants and consumers. And then before I turn it over to you, Andrew, for your comments, is the largest M&A deal in Australia's history. So what are your thoughts on what Square did with their acquisition of Afterpay?
Yeah, so I don't know if it's the biggest story of the year, but I read Peter's story on Lend Academy, and as he's an Aussie, it was really a great story. So I recommend and people read Peter's story. But it's really fascinating to read what Square and Afterpay have accomplished to date, and the fact that this is the biggest acquisition in the history of Australia, which is fintech to fintech. And what it means going forward in this transition away from credit purchases to buy now, pay later, which can be automated, streamlined, and facilitated at point of sale. So for consumers, it's a win, and for the two companies, I think it's a win. And in reading Peter's article, he said that he was kind of surprised until he kind of dug deeper into this because Afterpay had declined in value, and it really made sense for Square going after it because Square was a stock deal. I think it was all stock deal. Square spent a boatload of their shares to buy this company, but in the end, it really makes sense. It's kind of like a perfect match, don't you think, Todd?
For sure. And I think Square is quickly becoming quite a formidable force. For the big banks to contend with. It's no longer this nice fintech that has served the small businesses and kind of help them to get online and take payments in a faster, more seamless way. It's now quickly become a behemoth. I mean, if you read their earnings, I think some words of 80 or 90% of revenues in Q2 or Q1 was crypto trading based. So the Cash App has taken off. Now you add this element to it, and Square's is quickly rising to become the newest financial services behemoth, and really one for the digital age versus the chases that are now adjusting to the digital age. Square is perfectly positioned to just keep going forward and offering Afterpay type products to their consumers is only a natural evolution. And I think it allows them to hit on this trend of buy now, pay later, especially amongst the early, the younger generations who's, they're pretty against credit cards.
Yeah, and I get it. It makes a lot of sense. And as Peter said, that it's really become a verb in his home country, and that people are using this product like up to 30 times a year. That's incredible. But again, it makes sense. And from Square's perspective, Square they're kind of ignoring old finance and the brick and mortar crowd, and they're charting their own path, and they're doing it with velocity.
Yeah.
And it almost takes somebody like Dorsey that has a vision, who really didn't come from a financial services background, to reimagine what the future of uh, financial services are going to be. And kudos to him. I mean, he's executing, right?
Oh yeah, without a doubt. So we'll move to our second story, which would be, I thought, kind of a funny story in one way, because you have Apple that's partnering with a firm on buy now, pay later for Canadian purchases. I think it was just a few weeks ago you had Apple and Goldman announced Apple Pay Later, which is basically a competitor to a firm in one sense, and then they go and partner with a firm north of the border. I mean, it's buy now, pay later is obviously the hot term right now. Apple's been doing this for quite a long time with their devices and everything. You've been able to pay over time, and it's just a smart move to acquire more customers who view Apple products as pricey, and this gives them an in to not have to fork over high hundreds, low thousands for a product. You can give it the sense of, all right, I have to pay X amount over a month, and it'll take a year, maybe a bit longer. And it's an easy way to acquire more customers that might have been a bit reticent at the start.
Yeah, so I don't think Apple made an official announcement about BNPL with Marcus or Goldman in the United States, but it was sourced reliably, and
Yeah,
it
yeah.
absolutely makes a lot of sense. And as you mentioned, Apple's already doing this when you purchase an iPhone, because they give you an option to pay monthly. So it's a natural next step. I think that Goldman has a lot of data now from managing the underwriting of the Apple Card. It's really going to be. It should be a seamless transition. In regards to Canada, I can't recall if the Apple Card is working in Canada
It's
yet.
only US based right now, Apple Card.
So it kind of makes sense for them to move quicker and partner with I think it was BrightPay from which was an acquisition by a firm, and of course a firm's shares jumped on the news, which was good for Max Levchin and everybody who invested or holds firm shares, although they're not quite at the 52-week high yet, I don't think, but they did get a nice pop off that news.
The thing I wonder about not only Apple but like the Googles of the world is they've all said they don't want to become regulated financial services entities, whether it's a bank or they have enough tech regulation to maneuver the those in Congress that have begun to kind of hit them a bit harder now. So they have plenty of their own things to navigate. Is kind of how far do they keep going into financial services? And does it get to a point where Congress or other regulators begin to say, hey, this is as far as you can go before we begin to rein you in, or say, hey, now is the time you need to become a bank? So I think there's still early stages of where they are in financial services. Most of it is related to their products and stuff like that. But I do think there is a point in somewhere in the future where they're going to the rubber's going to meet the road.
So I kind of look at it this way. First of all, I'm a big advocate of fintech everywhere. I want financial services there when I need it. So I want it to be ubiquitous, but not cumbersome, not obtrusive. And I think Apple kind of gets that. Simultaneously, I use my Apple Card. I love it. I love how it works. I love how it operates. It's seamless. It's simple. And at the same time, I use multiple banks, and I hate most of them. One I hate more than the others, and I'm not going to
Yep.
mention the name, but banks kind of they don't get it. So I think that when some big tech say they don't want to become, a more regulated entity, I think they don't want to become more regulated like banks, but they want to find a way to provide these services without, running amok of Congress and regulators. Apple has long participated with a lobbying group in Capitol Hill alongside other big techs to advocate on behalf of big techs participating in financial services. And it absolutely makes sense. Like Bill Gates said many years ago, we don't need banks, we need banking services. And of course, the banks, they don't like that. The banks want you to say, hey, we can only go to that corner bank, when really we don't want to do that anymore. We want to access specific services at specific times, and we would rather, do it on our phone. And at least I would rather do it on my phone and, tap and review and off with it. I don't want to go deal with the teller anymore. I don't know maybe you enjoy that, Todd. Do you like, do you ever go to your bank anymore?
I couldn't. The only time I go to the bank is if I need more money than an ATM will give me. For a certain, whether it's, sometimes we do that for daycare or a larger purchase if we're getting like work done in the house, and it's a bit better to pay cash. But other than that, I never go to the bank. The thing I love about a lot of the options today is I no longer have to just go to my wallet and pick out one or two of the credit cards. I can see that if I'm on the Home Depot website, or if I'm on Apple, or if I'm on Target, I can, pick Affirm, Afterpay, whatever pay, and split it. And I don't have to worry about always going back into the wallet. It makes it so easy to buy something and pay for it in installments and never have to worry about where's my card, where's my wallet, do I have to, and then it's, it just, the seamless nature of it is giving them such an advantage over where banks are right now. And I know banks are starting to come into the space of buy now, pay later, but they are way behind at this stage.
Yeah, they can't move fast enough. They can't execute effectively enough. They really need to compete with themselves, and they can't do that. And I think that some banks are going to survive, some not so much. But I think overall competition is good, because that means more options for consumers and businesses. More importantly, small businesses. The only wrench in the works is if Congress gets overly involved, because the one thing that the banks, traditional financial services, are very good at is lobbying. They know who to talk to get things, mucked up for, the innovators. And hopefully, we can dodge that bullet and keep innovation moving along, because that's what we need, because it's good for consumers, it's good for the little guy, it's good for small businesses. It's just Congress has to understand that, and frequently they do not.
So next up, speaking on this, embedded finance track that we're talking a little bit about, you had Rapid raise 300 million at a 8.75 billion valuation. Fintech, or banking as a service, embedded finance continues to rack up a ton of venture capital. I thought the most interesting quote from their CEO, I think it was Arik Stillman, is, at the end of the day, there are 5 things on the planet Earth for financial services, whether you're a bank or a mom and pop shop: payment collection, money disbursement, fund storage, card issuing, foreign exchange. From these 5, you can build endless capabilities.
Yeah, I mean, it's fintech as a service, payments, transfers. It's a hot sector right now, and it should be. Europe, United States, North America, Asia. I think we're just in a big trajectory of growth right now, and it's kind of emblematic when you have a transaction of this size, where Rapid raises such amount of money at a significant valuation. It's just indicative of where we are now and where we're going. And you probably know that the laws are a little bit different in depending on the jurisdiction, and in Europe, you can do a lot of banking services without being a bank, and that's helping to fuel innovation.
Yeah, I'm curious how long it takes for something to become, um, regulated here like that. I know the CFPB came out with their, um, you know, um, I don't know what they called it, but basically their directive, which is not a law, so I'm sure it has limited use. But to your point that you want fintech services that you said earlier to be ubiquitous and not hit you over the head. Banking as a service, essentially every company should now be able to offer some level of financial services to make your life that much easier. And so companies like Rapid and others are just continuing to take that theory and just spread it like wildfire all over. And I think the biggest beneficiary is obviously the consumer and small businesses, as you say. And eventually, I think we do reach the point where there's just a mass consolidation of small banks because they just can't keep up. I think they're benefiting right now from legacy customers and some of the fees, which we'll get to in a little bit. But once some of that starts going away, especially the fee income, they need to look elsewhere, and they're going to be very far behind when they start looking elsewhere.
Absolutely agree. Absolutely agree.
I wanted to move next to a company that we probably don't talk enough about, but was one of the earlier fintech pioneers, Lending Club. So Lending Club bought Radius Bank, which is now going to become Lending Club Bank. They recently had some pretty good numbers. Marketplace revenue grew 86%, 105% growth in origination, 132 increase in gains on loan sales. So consumer loan portfolio jumped to 795 million, 145% growth. Net interest income 148%. Deposits grew 2.5 billion. I'm really fascinated how this I don't know if I'd call it experiment, but how Lending Club Bank works out. Because this might be the path that can save some of the community feel in banks, but at the same time, let fintechs take over that bank and spread it. Because I think you're going to start seeing more of these as long as Lending Club doesn't fall flat on their face.
Yeah. So I think that you make a lot of good points there. Lending Club and Lending Club Bank, I'm bullish on right now, and probably about a year or so ago, I wouldn't have said that. I think that they made a good decision in acquiring Radius, getting that federal bank charter, which is key, and it appears that their decision is paying off right now. And if you dug into the earnings announcement that came recently, they were even a little surprised as to the results. And part of it was predicated on the fact that their cost of capital to originate loans dropped because they cut out the middleman, which was WebBank before. That makes sense. Part of it was driven on the fact that they are keeping loans in their books now, and they can generate more revenue that way. That makes sense. The other thing was kind of unanticipated, is they didn't realize that once they became a bank, they became part of the club, and banks said, well, you're regulated like me. That makes me feel safe and secure. And so now, banks are doing, I think, half of the originations, including Lending Club Bank. And that was something that they didn't really anticipate. Plus they ended up with more deposits than they anticipated. The one caveat that I have here is that being a digital bank, you've got to do more than traditional banking. And as a digital platform, you have the opportunity to iterate rapidly, even in a highly regulated industry. And you've seen that exemplified in some other fintechs that just move very quickly. And you don't have to move at lightning speed, but you have to recognize the fact that you can create new features and services that are of interest to your customers with greater rapidity. And I think, Lending Club is kind of at the cusp of, where do we go next? And so they should, start to really roll out services that really drive more benefit to their customers, to get them coming to their app, a couple times a day instead of a couple times a month, and to offer more new and unique services that you'll never get from a traditional bank. So once again, I'm kind of bullish on Lending Club right now. Their shares jumped dramatically, as they should have. I listened to the call. You had the few analysts that participated congratulating these guys, which is kind of a rarity. So right now, hopefully they're celebrating, but then it's back to work. What are we going to do that's going to be creative, innovative, to not only service our current customers, but drive interest from new customers, which is hard in the United States because the market is so fragmented.
Yeah, I mean, I think Lending Club is on their way to oblivion, to be honest with you, before this move. I think they were going to be around for a little while. You had COVID, which certainly impacted lots of companies. Nobody's fault, but I just think Lending Club was on their way to being acquired. Maybe not in the same exact way as On Deck was, but they were kind of on that path, and they made this bold move. And I think it reinvigorated probably many people at the company who were working there for quite some time. And like you said, it put them in the club. They're in the club, but they can work at significantly faster speed than many members of the club. And so it can give them a leg up, and they can really start to take off from here as long as they put the pressure on creating those products, those experiences, and say we're the bank that can do it versus the others that take too long to do it.
Yeah, and how many fintechs, purely digital platforms, have a national federal charter right now? You have Marcus, Goldman Sachs. You have Varo Bank, Varo Money. You have Lending Club, and I think I'm forgetting a couple. But there's not a whole lot of them. Nope. So seize the day, move quickly, promote what you have to offer, and offer new services that make me want to dump my relationship with the bank I hate, that I've had a relationship for decades, and surge ahead. Fortune favors the bold.
Now, the next story I think is obviously it's one that we've talked about many times here in terms of overdraft and fees, but I really think this is where, if I was a community bank, I'd be terrified, because the big banks are the ones that get in real trouble PR-wise from overdrafts. The papers cover a real big number. If you look deeper into it, as a percentage of revenue or profit, is very, very small. But still, I mean, they can see, this company, they made $39 billion in overdraft fees the last 3 years. And that's a huge number, and it plays to people's sympathies. But when you really look at it, Peter had a great podcast with Aaron Klein a couple of weeks ago talking about it. Some of these small banks make almost their entire profit on overdrafts and other fees. And if those are regulated out, in maybe not fully regulated out, but to the point where they can't make this margin on it, and they have to be really fair about it, those fees are essentially gone. The bank is no longer profitable, and they need to make that up somewhere. So that leads to two paths. One, they partner with a fintech or become really, really innovative and take that path. Or two, they're just acquired, and that bank is off the map.
Yeah, I mean, the $35 coffee, right? You go over by a couple dollars and you get hit with this huge fee. It's probably happened to everybody. It's really idiotic. If banks were smart, they would eliminate the overdraft fee completely, immediately. Because the worst case is that you have an agency or Congress that they do it, and that would be 10 times worse than the industry managing it themselves. So that needs to go away. It needs to go away. Last year, I saw one quote saying that last year there were $12 billion in overdraft fees for the banks. I don't know if that's accurate or not, but still billions of dollars of people getting gouged when they shouldn't be. If you take out a little bit more than you have, and you want to charge, a slight interest rate on that money, knock yourself out. But these fees are ridiculous, and they need to go away.
Yeah, I'm sure it's a very limited amount of people who take overdrafts to an obscene level, like 400, 500, $600. I'm sure that user or that customer is very few and far between. Most people end up overdrafting 3, 5, 10, 8, somewhere in there where it's like they think in their minds they have enough for the coffee or something else, and they realize something else came out of their account, and now it's, oh crap, I'm $3 over. And so we need to eliminate the gouging, certainly on them. And I think I agree with you in the sense that it's much more better. It's much better if it's done by them because they know their business models and how their business models work. Congress, as you've said, I've said, Peter said, is not very savvy on the business model and understanding how the system really works. And they'll force this upon them and it'll be a disaster.
It'll be a disaster. So you need to, like a JPM Chase, to make an announcement that we're eliminating all overdraft fees, just so they get the PR pop, and they'll generate returns on that immediately and feel good, as opposed to waiting to for Congress or the OCC to bollocks it up. So
we have time just for a couple of quick ones here. First, I wanted to, before we go to the infrastructure bill and digital assets, I wanted to get your thoughts on Figure merging with Homebridge. Homebridge is a top 30 mortgage originator. Now they partner with Figure and Provenance. They can take that if Cagney's assumptions and quotes in the article are correct, and basically supercharge that. And then this will be what can prove out Provenance, the technology behind Figure, can really prove it out at scale.
yeah, first of all, congratulations to Cagney. Lightning strikes twice, two fintech unicorns in a few years. Kudos to him. I mean, you got to give him credit for creating SoFi, leaving, and then creating something pretty different because it was blockchain based, and proving it to traditional financial services firms that it works. And it was all predicated on the fact that you can use this new technology to streamline processes and chew off basis points. And when you're in a scale business like mortgages, it makes sense. So I think that this is a fascinating deal. I'm not so hot on brick and mortar personally. Like you said, it's a big mortgage originator. My guess is they saw a path to starting to streamline that brick and mortar operation over time, while driving their margins higher.
And I think if it proves out on a mortgage blockchain, I think the banks can start seeing that this can work for simpler products on top of the complications that a mortgage presents. Last story we'll go with is the infrastructure bill. There was a piece of the infrastructure bill which was related to digital assets. Basically making it so changing the term broker and potentially putting a lot of KYC on customers of various platforms, both crypto and DeFi. Andrew, tell us a little bit about the bill and what that might mean.
So this is why Congress is terrifying, because this is a 2,700 page bill that probably two people have actually read the entire thing, and there's no telling what's in there. I mean, it's just it's just it's a sausage factory, and that's how our government works. The industry somehow got a draft copy of it when something was added regarding digital assets, and it came from the Senate side. I'm not sure who snuck it in there, but as you mentioned, they broadly defined a broker in regards to digital assets transfers, which was basically everybody and anybody. If you owned a digital asset and or you transferred a digital asset, you're a broker and you had the KYC, AML, everybody, and that really didn't make a whole lot of sense. Now you have FATFA doing the travel rule, And that's something that is over time being implemented where virtual asset service providers or exchanges are required to maintain records on transactions over a certain size, and it kind of aligns with the Bank Secrecy Act, and that kind of makes a little bit more sense. But the language in the infrastructure bill, and I love how infrastructure has gone far beyond anything having to do with highways, and airports.
Yeah, exactly.
It really didn't make a lot of sense. Again, congratulations to Senator Patrick Toomey. He jumped on it immediately. We had Senator Loomis from Wyoming that joined in, and then they got Senator Ron Wyden, who's the chair of the Finance Committee, to support their amendment, which has been submitted to change the definition of the broker, and it was moved rapidly. The fact that you have bipartisan support with this amendment means it will probably get changed. But who knows? We're talking about the House of Representatives and the U.S. Senate, and we've seen time and time again, the magic they possess to create, incredibly bad legislation.
The best and the brightest, they are not. And Andrew, we'll have to leave it there. Thanks again for joining us on the show. Thank you to the audience. Next week, you won't see me. I'll be on vacation, but you'll be seeing Peter, Bo, and a new special guest. So we'll see you next week. Andrew, thanks again. Thanks, everyone.
Thank you, Todd. Thank you, everybody.